Hey guys, thanks so much for joining us. We're going to give everyone a few minutes to jump on in. For those that are just joining, please feel free to start typing in the chat where you're located. We want to know where everybody is at before we get started. So let's start chatting through the chat and we'll start here in just a few minutes. Thank you all. Argentina, that is a far ways away. I think you might be the furthest. We got some people from Utah, from California, Arizona. I love Arizona. Nice and warm there. This is great. Got a good mix so far. Who's got their holiday shopping done? Where are we at on that? I'm personally far behind on this. Is anyone ahead of the schedule here? Got New Hampshire. Thanks, Yoshi, for joining. Sean's behind. Sean, you got to get on it. We're only a couple weeks out. Awesome. We have some more people kind of trickling in right now. So we'll give it a few more minutes before we get started. So feel free, if you're just joining, come on to the chat. We're kind of talking through our holiday shopping list, where we're at, where we're located. So let's all get acquainted before we get started. Ben, a December 24th shopper. That sounds hectic and so stressful. That's horrible. Awesome. All right, you guys, we are going to get started here. So thank you all so much for joining us today on our Tax Talk and Tips, your guide to 2024 success. My name is Murray Wright, and I will be your host for this webinar. I know I asked you all where you're located, so I'm located here in Salt Lake City, Utah. It is winter here. We're starting to get some snow, and I'm a big skier, so I'm very excited about this. We're a little behind from last season on the snowstorm, so we kind of need some more, but very excited to be with you all today. I've been the past 7 years in tech sales specifically, and right now I am a senior account executive here at Zeni. So very excited to kind of jump into our webinar with you all. And just so you have a little background into Zeni and what we do over here, Zeni is an AI-powered financial concierge service, combining AI with human financial experts to give founders real-time insights all on one of our dashboards. So Zeni will be a one-stop shop for you all from a financial services side. This is including bookkeeping, accounting, CFO services, and our main topic today is taxes. So I know I asked also a little bit about where everybody is with their shopping. So I'm sure everyone's got their holiday shopping list at the forefront of their minds. Or if you're Ben, you're waiting till December 24th. And taxes are not due until next year. So why are we worried about them now? Well, just like building your product, preparing your taxes doesn't just happen overnight. And in fact, there are deadlines that are actually due this month. And so that could, having this information could help save some time and money. So we hope we walk away from this webinar better prepared and armed with information to make your tax season stress-free. So I'm very excited to jump into this a little bit more with you all as well. I want to give you some information quickly on who I'm sharing the stage with. I feel very privileged to share the stage with these three very knowledgeable tax experts who combined together have about 50 years of experience. And I'll let you all introduce yourselves.
Hi everyone, this is Meenal Garg, Director of Taxes at Zeni. I am California licensed CPA with over 20 years of experience, mainly in startup taxes. I love taxes because they are complex, they are challenging, and that keeps my learning growing. I love to help my clients with all those complex reporting, keeping them in compliance, and save the taxes wherever they are eligible for it. That's all about me. Over to you, Terry.
Thanks, Meenal. I'm Terry Goddard. I'm a tax manager here at Zeni. I've been with the company since about May of this year and absolutely love it. Love helping you, the entrepreneurs. I'm an enrolled agent, and I have been helping startup founders for over 20 years now. And I enjoy the tax realm because, you know, I enjoy sharing information. I enjoy teaching the entrepreneur how to navigate this complex system. Whatever I could do to help you and to help you understand better your tax situation, that's what I'm here for. So over to you, Minal.
Thanks, Terry. Welcome, everyone. I am Meenal. I am working as a US tax professional for over 8 years now, and I am waiting for my CPA license. I joined Zeni around 3 years back, and from there, I had an amazing journey so far, working with such amazing team and amazing clients across different industries. I think of tax as a puzzle that is never solved, and I always enjoy working to find that last piece every day. It is intellectually challenging for sure, and that's what I love about it. Thanks, Marie. We are going to have an amazing session today. I'm pretty excited about it.
Thank you all so much for the quick introduction. So here's a look at our agenda today. Just some housekeeping notes as well. If you miss any of this webinar, we will be sending a recording out and a follow-up email along with the assets that we'll be sharing during the webinar. So additionally, say hello in the chat box. Please feel free to ask questions here. This is where we'll answer everything during our Q&A. So feel free to jump on over there right now. So this quote I found very fitting, and I wanted to share this really quickly with you all. So every year I make the same mistake on my taxes. I try doing them myself. So this is what we're hoping to prevent you all from saying. On our end, we really just want to make sure you feel equipped to understand taxes, and hopefully this webinar will be helpful. But I do want to quickly pull a poll in the chat really quick. Please feel free to answer this. So how many of you are filing your business taxes for the first time? So let's see where everybody's at this year. We got a few people saying yes. Okay. And some people saying no. So this webinar will be super helpful for you all to have better understanding as to what will be going on. And we'll be sharing some insightful tips to you guys as well. So I would like to hand this over now to Manal to get us started.
Welcome back, everyone. Today, I'm going to address the number one question I've been getting from new business owners who started their business in 2023 or maybe in prior years. And that is, do I actually need to file the business returns? So, if you have the answer, who needs to file the business tax return, please put your answer in the chat box and let's see what are your thoughts. I am sure we have startups here in all different stages. Some are pre revenue, maybe in Series B, maybe in Series C. Let's see. Wow, we have a couple of answers. Great. And the short answer to this is a big yes. I often hear the misconception that there's no need to file until you have revenue or you have significant expenses, which is not the case. You want to file regardless of your size and the revenue. Understand it like you register for a class in a college and you do not submit your assignment. Then what will your teacher do? They would be coming to you looking at your assignment, right? Same way, if you are incorporated and you got your EIN from IRS, IRS is looking for your tax return. This is a requirement that you need to comply with. So this was for whether you need to file a return. But now I would like to actually shift my focus from why you have to file the return to why should you, how it is going to be beneficial to do. First is it's a compliance requirement, which we just discussed. Definitely, it's going to save you from the trouble of IRS reaching out to you with notices. But yes, there are other advantages as well. Biggest among that is the annual carry forwards, which means that this year's loss can help you reduce next year taxable profits, profits on which you were actually required to pay the taxes. So suppose you had expenses to get your business off the ground for, say, for example, $50,000 and no revenue at all, which makes you in a loss position of 50,000 this year. And say after 2 years you are up, running great, making a profit of $100,000. So this 50,000 loss can be actually used to reduce 100,000 profits, and you pay the balance portion of the tax only. That sounds interesting, right? So this is a direct benefit, and this is actually possible only if you file the return this year claiming that 50,000 loss on your return. Another advantage is simply the benefit of being compliant. So if you are thinking to apply for an IPO or fundraising or any kind of acquisition, you need to have the transparent records. Being non compliant can impact financial assessment for sure. So it's completely on you how you want to take this. I am sure for all the first time filers, it can be overwhelming, but it does not have to be overwhelming. It can be as easy as pie. You just need the right text preparer for yourself, and if you have that, then everything will be effortless. And with this, I am going to go on the next section. So, as a founder, what all tech services you might be looking for? Okay, so this chart shows the three most common buckets tax filing fall under for startup founders. So first is the income tax returns. This includes federal filing and the state filing based on your operations. And this is, and then in case you have presence in any country apart from US, you might also be required to meet the foreign reporting obligations. I will discuss the foreign reporting obligations in the next section. Further, in case you are involved in R&D, of any kind, you may also explore the eligibility of your business to avail R&D tax credits, which is a direct money in your pocket. So my friend Terry is going to discuss this in detail in the sections to come. Apart from that, you may also have certain ad hoc requests. So suppose you want a name change with IRS or the address change, or how to respond to the IRS notices and penalties and so on. So this can be another area where you might be looking for the tech services. Apart from that, another area that you should be taking care is the sales tax filing. You need to first check which states you have nexus and to file the sales taxes, and then finally you need to register in those states, and also you have to file the returns in those states timely and appropriately. So as a founder, you need to take care of all these multiple areas of compliance.
Thank you, Manal, so much. I just want to pause here for just a second. It sounds like we had some questions in the chat earlier from June. Wanted to see if there's anything else, any other questions on this side before we jump into foreign reporting. So feel free to throw those into the chat. Manal will be kind of going through those on the back end, but I want to ask another question for everybody here. How many of you have a foreign subsidiary? Please put that in the chat if you do. So realistically, it's no secret. We are a globalized economy and most businesses have an OUS entity. So Manal, I do have a question directed towards you specifically. What do we need to include, if anything, in our tax filings about foreign subsidiaries?
Okay, for that, our whole next section is related to. Let's quickly jump on foreign reporting. So, for understanding foreign reporting, I have broken down this in three major categories, or you can say three foreign reporting rules, which you can keep in mind. So, first is 10% rule, which is if you have 10% or more ownership in a foreign subsidiary. Second is 25% rule, which is if 25% of or more of your company is owned by a foreign person or a foreign entity. Or the third one is the $10,000 value rule. So if your business has funds in foreign financial account. Elaborating on each of these, let me start with first the 10% rule and the basically the applicability of Form 5471. So this is the reporting when your corporation has invested in a foreign subsidiary. So for example, the US corporation is holding voting stock in a UK entity. So maybe while you were focused in on setting up your business and in between you invested in a foreign corporation, but in Hessel you forgot to file Form 5471. You might get yourself into trouble if that ownership is 10% or more. This reporting of forms starts the moment you have ownership in a non US entity above threshold. Moving to the next filing, which is 25% rule and applicability of Form 5472. So, this reporting is by US company which are wholly or partially owned by a foreign entity or a foreign person. So, basically, if you have a foreign shareholder holding 25% or more in stock, this applies to you. So, for instance, just to give you a brief example, so if your US corporation has issued 25% stock to the UK based entity, or if your US corporation has issued 25% stock to a UK national, Mr. X, so then this is what applies to you. Last one is $10,000 value rule and applicability of Form FinCEN 114, which is FBAR. This form is often misunderstood. The name of the form is FBAR, which is Foreign Bank Account Reporting, but actually, this is Foreign Bank and Financial Account Reporting. Financial account includes all kind of bank accounts, maybe checking account, a deposit account, or a saving account, and also it includes securities account, brokerage account, and if you have any shares in mutual funds and similar pool funds, and so on. So all this comes under the financial accounts. So if you have any of these accounts abroad and at any time you had balance of $10,000 or more, you need to make the FBAR reporting. FBAR reporting is comparatively simpler. You just need to ensure that you are able to assess the applicability correctly. Also, remember that this is a calendar year reporting and it will be filed separately from your tax return. Irrespective of tax year you are following, it will be your calendar year reporting only. It is filed with US Treasury and not to IRS. So it's separate from the tax return that you have to always keep in mind. So always remember these three rules when it comes to foreign reporting: the 10% foreign investment rule, 25% foreign shareholder rule, and 10,000 foreign balance rule. I have always seen that everybody wants to be compliant, 100% compliant. Everyone wants to do what they are required to do. What builds the gap is the unawareness. Most of the founders struggle to understand what information they need to provide to their tax preparer, what can be relevant for them. With respect to foreign reporting, remember these three rules, and this will help you understand that it's time for you to discuss the foreign reporting obligations with your tax preparers. There is obviously no reason why you would not want to do this because these all forms are only the informational filing. There is no additional taxes that will come out of this form. So why not being proactive, right? We should be. Coming to the next slide, which is the scariest part. But before that, let's try to understand what really is the purpose of foreign reporting. Why IRS wants you to file these reports and why additional reporting is required. The most significant or straightforward answer to this is that all these forms are fundamentally designed to prevent tax evasion. The US government is concerned that companies with substantial foreign relationships could potentially evade American taxes through disguising the transactions. Every year, you show to the IRS what you are doing in your US company and you pay taxes on that. You file 1120 with IRS. But what's going on in your controlled foreign company, IRS is not aware of that. What if you report foreign expenses in your US corporation return? Or what if you transfer your revenue earned in the US corporation to a foreign company? All this will reduce ultimately the US taxes. IRS wants to keep a check on all these transactions, and that's why all these reported additionally. That's it. Coming to the numbers of the penalties. If you do not report 5471, there are huge penalties. There is a flat penalty of $10,000 for not filing the form per year per foreign subsidiary. So, for example, if you had two subsidiaries not reported for 2 years, you just simply get a text notice of flat $40,000. Definitely, you would not want to expose yourself to that kind of risk, right? Next one is the penalties related to misreporting 5472. This can cause flat penalty of $25,000. And not just that, it's $25,000 per mistake. This can be more and more if you continue to fail. Finally, the last one, F bar. The penalties for not filing F bar can be as high as $100,000 or 50% of the balance in the account. Yes, all this sounds scary for me also, and the IRS is not lenient on any of this. So just be sure that you are filing these forms whenever they are applicable. I would also like to quote an example here about one of our client that had a name change, and they could not report that to IRS properly. So the IRS had two records of the same entity. On one record, they reported details of foreign entity appropriately, but on the other, it was all blank because it was a duplicate record. IRS sent the notice of $70,000 of penalties considering this as a misreporting. Luckily, we were able to correct this error on their behalf, but it's a very good example of a small mistake leading to big penalties. Finally, if you are ready to take the next step towards getting your filing in order, get in touch with your tax preparer ASAP. The failure to file an international form can uh, can totally give you a lot and lot in penalties, and even worse, there are very high probabilities that you could get audited. This is why we actually advise all our clients, when in doubt, just go ahead and file it. Doing something more is much better than doing something less. Thank you so much for your patience. And yes, we have a text material for you. This is a very complex reporting, and we definitely can't cover everything in the session. So we have some reporting guide for you. You can go ahead and download that, and this can be referred later on for sure. Also, you may feel free to drop in any questions on chat. We will take in Q&A towards the end. Thank you so much.
Thank you so much, Manal. We appreciate that. So definitely download the handout. This will be helpful in just giving you some more information for avoiding these penalties. Or you could just have Manal handle your filings for you. That might just be the easier route on the back end for everybody. So next up, we are actually going to jump into R&D tax credits. This is something that I know is a significant subject in the startup community, with tax specialists who solely focus on preparing this credit. So Terry, I'll let you take it from here.
That's right, Murray. I have a quick question for all of our listeners out there. How many of you know what the R&D tax credit is, or have you heard of it? Give us a thumbs up or a thumbs down in the chat, and just to kind of get an idea of where everyone is with this. Yes, yes, awesome. Sounds like a lot of you know about the R&D tax credit. I hope that I can give you a little bit more information about that right now. So let's get into it. So the R&D tax credit, the research and development tax credit, it's used by companies. Generally, it was used to offset their tax liability. But as many of us know, we can now offset our payroll tax liabilities. So up until 2016, the R&D tax credit could only be used against your income taxes. After that, for startups, well, I should say for startups at that point, there really was no benefit of taking this credit. You couldn't monetize it due to little or no income to report. But since 2016, you can now elect to monetize this credit by offsetting the employer portion of your payroll tax credits. Let's see. So as far as the payroll tax credit, this also has been a significant change for this year. Prior to 2022, this offset maxed out at $250,000, but as of 2023, this offset is now up to $500,000. There are, of course, qualifications around this credit and whether or not you're able to take it. Currently, it includes that your current gross receipts have to be under $5 million. You cannot have any gross receipts for the prior 5 years. And your utilization begins the quarter after your income tax return is filed. And then any unused R&D credit that you've elected for this offset can be carried forward to the next quarterly payroll tax return, so until you use it up. So it really is something that benefits our startup founders. So just for example, let's say that you did file your tax return on April 15th, which is in quarter 2. That payroll offset becomes available in quarter 3. So with your 3rd quarter payroll tax return, you're able to monetize that credit, which is really huge for some of our founders. This could be your very own bridge loan, basically waiting for that next round of funding or that bank loan that's coming through. Let's see here. So as far as the eligibility around what kind of costs you're allowed to take for the payroll tax credit, or even just for the R&D credit, there are certain conditions that that must be adhered to. You must be designing and developing a new product or new and improved products. There must be a technological nature around this component. There must be technical uncertainty. You must be undergoing a process of experimentation. Your company must maintain the rights to this product, so you must bear the risk of any of that work that's being performed, and that work must be performed in the United States. So any work outside of the US, let's say you're paying that contractor outside of the US, that will not qualify for this R&D credit. And then finally, these are the eligible expenditures that could qualify for this credit. So wages, again, these individuals, your employees, must be actively performing the R&D work here in the United States. You can also take some wages for those that are supervising the performance of this activity, as well as those that are supporting the R&D activity. Supplies, these must be physical, tangible items that are consumed in the United States during the R&D process. You might be able to, supplies purchased overseas could qualify if they are consumed in the United States. Leased computing costs or cloud hosting, Google Cloud, AWS, those types of costs are also allowed for this credit. And then your contractors, so any US-based parties in which your business pays to perform this R&D work in the United States can qualify. However, you must take a look at your contracts between these individuals. Your business must maintain the rights to the work performed, and your business must be at risk for the work being performed. Let's see, Marae.
Amazing. That is a lot of information. And so we did provide some more additional handouts for R&D tax credits, some guidelines going through what Terry had just discussed. So feel free to download those as well. So that way you can refer back to those and leverage those going forward for R&D tax credits specifically. Now, Terry will be diving into Section 174.
So Section 174, you might have heard some talk about it. Also the impact it may have on your R&D tax credit. So here's all the hoopla around 174. As tax professionals, we really thought that they would redact this, but they haven't. We believe it's here to stay. They've just recently issued some additional additional rules and law around it. So it's something that we definitely need to take a look at. So Section 174 is not new. It has been a part of the US tax code forever. But generally it had allowed businesses to deduct specific research, development, and experimental costs from their taxable income. The Tax Cuts and Jobs Act, enacted in 2017, has now changed that law. And we thought, as we said, we thought that this was going to go away, but in 2022 is when it started. And these changes have now become permanent. So prior to 2022, taxpayers could choose to immediately deduct their eligible 174 costs, or they could capitalize them and amortize them. So basically not taking that full deduction, but spreading it out over a few years. The new law requires taxpayers to capitalize and amortize their Section 174 costs. And the criteria is basically any domestic research costs must be capitalized and amortized over 5 years. And any foreign research costs, so anything paid overseas, must be capitalized and amortized over 15 years. So this really spreads out that deduction. And in some cases, which we'll see here, could, as in this case, it could be a surprise for some of the startup community. Just for example, let's say in 2021, you were now earning income, you had revenue of around $100,000, and you had those research and experimental costs of $150,000. You were able to deduct those 100%. Basically no net income. You'd have that net loss that you could carry forward. Now in 2022, you must capitalize those costs and amortize them. So you may only receive a $30,000 deduction, which brings you into a net income position of $70,000, and you have tax due. So that definitely is something that you want to take a look at. You know, this affects your cash flow. It's been a surprise. We have had a couple clients where this has happened to them, and it you know has not been a good surprise. We'll tell you that. So ultimately, for Section 174, everyone's impacted. This is a requirement. This is not something that you elect to do. You must be capitalizing and amortizing these costs. So to take a look at that, you know, you may have a tax liability depending on if you are earning income. The R&D tax credit, you should take a look at that as well alongside of Section 174. Any R&D costs are Section 174 costs. Vice versa, not so much. So Section 174 is much broader. You must look at any direct and indirect costs. And so this is something that, you know, we've had some clients that say, well, if I, you know, choose not to elect the R&D tax credit, do I still need to look at 174? And the answer is yes. You still must look at Section 174. You know, taking a look at this, it can affect your cash flow if you do have that tax liability. So, you know, something that before year end, you may want to take a look at these costs. And then if you do not, if you ignore Section 174, this is definitely an audit risk. This is an accounting method that must be applied to your financials for tax purposes, for tax filing purposes. So it's something that you do not want to ignore. You want to take a look at it, and we can help you do that. So.
Thank you so much, Terry. This reminds me of our opening quote as to why I don't do my own taxes. There's a lot of information here, so I really appreciate you, Terry, diving into that a little bit more. We're almost at the end of our presentation portion of the webinar, and I know we've covered a lot of information. So what would be the key takeaways our guests should walk away with?
Let me cover that. So thank you, Terry and Meenal. Wonderful information you shared. So, but it is too much. So let me give you some key takeaways. First and foremost, you need to file your taxes. As soon as you have incorporated that entity and you have obtained that EIN, IRS is looking for that return. And that, in fact, as Meenal said, it is beneficial for you, so act fast as soon as you incorporate that entity. Second, again, is the most important thing. While you are like busy setting up your foreign subsidiary or for getting that fund from the foreign shareholder, you still have that reporting requirement going. So while planning all those things, you should keep in mind that there is a foreign reporting involved, and if you miss, there is a significant penalties looking for you, and that can start with $10,000 at a minimum. So think about that when you are going in the foreign reporting. Don't avoid that. And third one is the R&D credit, which is tremendously helpful for your startup. It can literally give you cash money back. So don't leave that money on the table. Fourth and foremost, which is a new tax law change, Section 174. We have seen the clients like their books are showing a loss, but when we come to prepare the return because of Section 174, they are in taxable profit and they have to pay the taxes. It directly impacts your cash flow. It directly impacts your tax return and every planning that you have done. So act on that fast, because this is not a optional section. This is mandatory. IRS is looking for that reporting in your tax return. So act proactively there to work with your tax preparer and find out like how it can impact your tax returns. And finally, like we know, like we have a lot of information shared here, so we have these assets, these details, all the guides for you. You can download them and keep them handy for your reference.
Thank you so much. We covered a lot. And I would like to give an opportunity to ask any questions. I know we've had a lot of questions come through the chat, so we really appreciate that on our end as well. So feel free to continue throwing questions in the chat. But while you guys are typing in some of your last minute questions here, I did want to talk about a little special something that we're giving away. We are doing a special referral promo. So Zeni is offering to all of our registrants today. This is a promo for our bookkeeping services and accounting service. If you refer yourself or another founder, you will receive a new iPhone 15. So how about that, adding that to your holiday list? So please refer to the flyer details below for that additional information when it comes to how you can get an iPhone 15, and who doesn't want one of those? So now we'll jump back into taxes. It looks like we'll have some questions here in just a second, but to kick us off, we did have a few questions come in during registration. And so I wanted to address these while you all are going through your questions as well. So the first question that I have for our lovely tax ladies here is, what are some of the top mistakes you see early stage companies make on their taxes while they are fundraising? Minal, do you want to take that one?
Yes, sure. Of course. So I've seen that early founders do a lot of mistakes, and one of the most common mistake is they do not take their taxes very seriously. They many times wait to generate revenue to start the filing the taxes. We need to understand that tax reporting process starts with the formation. Another mistake I've seen is not recording the expenses appropriately. So in initial year, we have to understand that we have to make sure that personal and business expenses are recorded correctly. There should not be overlapping of the expenses. So all the expenses should be recorded correctly, and they have to be claimed on the tax returns correctly. Also, startup founders are many times not aware about the advantages of the credits. There are many kind of credits that are available, and you should, like for example, R&D credits. So you should always explore the opportunities, what all credits can be applicable to you, and always try to take advantages of those all credits.
Thank you so much, Minal. Okay, the second question that we had come through the registration, and Terry, I'm going to direct this one to you. Do you have any information about R&D tax credits specifically for the AI space, or other good ways of maximizing deductions for pre-revenue startups?
Yeah, this is a great question. So as far as any information about R&D tax credits, I think we did cover a lot of that. Maximizing that credit really would be using those U.S. contractors, U.S. employees, because the foreign expenses are not qualified for the R&D tax credit. And also, kind of piggybacking on a question that we received in chat, you must, for the payroll offset, that must be elected on a timely filed tax return. So not by amending the return, not on a late filed tax return, but you know, on your original timely filed tax return, you must make that election for the payroll offset. So, you know, as far as maximizing those deductions, you know, they really are pushing for the U.S. Work here, you know, just to keep that in mind.
Thank you so much, Terry. So last question that we received, and Manal, I'm going to direct this one to you, is are there any tax implications if I hire independent contractors and not employees?
There are no tax implication as such. In fact, that is beneficial for a startup to have the contractors because they will avoid those payroll taxes and payroll compliances. But again, like there are two downside of it. One, if you have the foreign contractors, you might be looking at a separate reporting, which is like foreign reporting for foreign contractor payments, W-8 ban and 1042 filing. So that could be a little complex because you need to withhold the taxes there. Second thing is like if you are doing the R&D tax credit, this foreign the contractor that you are paying for for R&D tax credit, US contractor costs are only 65% eligible. So you are losing that 35% of those costs, like which you are incurring to do the R&D development with these contractors. So no direct impact, but yeah, these two points you can keep in mind.
Amazing. Thank you all so much. And we really do appreciate everyone joining us today for our webinar. If you are interested in having Zeni do your taxes, or you want to know more about any of our other Zeni services, you should see a pop-up on your screen to schedule a time with me. So I'm more than happy to dive in and kind of explain this a little bit further with you. Again, we will share a recording of this webinar along with all the copy of the assets that we have shared today in the chat with you. So we wish you guys happy holidays, and we look forward to connecting with all of you hopefully very soon. Thank you all so much. We appreciate it.
Thank you.